Imagine waking up and your savings are worth a quarter, 25% of what they were yesterday. Well, that happened in Peru, and the warning signs were visible 12 months before it all broke. All three of those warnings are actually flashing right now in United States data. Don't let what happened in Peru happen to you. Watch this.
7,649%. That was Peru's annual inflation in 1990. In August of that year alone, prices rose 396.98% in a single month. The currency was replaced twice. The first replacement set 1,000 old sols equal to 1 inti. The second set 1 million infis equal to 1 nuevo sol. Net result? 1 nuevo sol equaled 1 billion of the original currency units. The savings passbook that said 1 billion soles in 1984 said 1 nuevo sol in 1991. Same account, 1 billionth of the value. This did not happen in Weimar Germany 100 years ago. It happened in the 1980s in a country with a modern central bank, an elected government, and a functioning middle class. 3 markers were visible in the public data 1 full year before the worst of it arrived. The United States currently has 2 of those 3 right now. By the end of this video, you are going to know exactly how a modern currency goes to 1 billionth of its original value, which 2 of those 3 markers are already confirmed in US public data, and the 3 specific moves the Peruvian households that came through actually made before the broadcast that ended with "May God help us." The United States is already 2 markers in. The first, entrenched inflation and stagnant growth. Peru hit 70% annual inflation before hyperinflation took over. The US version is a structural fiscal deficit, projected at $1.9 trillion for fiscal year 2026. Debt to GDP is at 102%, heading for 120% or higher if nothing changes. The second marker, collapse in export revenue and a debt spiral that shuts off international refinancing. For the US, that is the erosion of foreign demand for treasury debt. Foreign ownership of marketable treasuries has dropped from 50% in 2014 to 32% in the first quarter of 2025. The dollar's share of global reserves is down to 56.92%, a multi-decade low. The DXY dollar index fell 10% in the first half of 2025, the biggest 6-month drop since 1973. The third marker is the loss of central bank independence. That is when monetary policy stops serving price stability and starts serving the government's fiscal needs. The US has not crossed that line. The Federal Reserve is still formally independent. That is the tripwire. In every Latin American hyperinflation, the sequence only went terminal after the central bank lost its independence. 2 markers are already confirmed. The third is the one that matters now. Peru did not stumble into this. On July 28, 1985, Alan Garcia took office and announced a hard cap. Foreign debt service would not exceed 10% of export earnings. This was not a negotiation. It was a line in the sand drawn against the IMF and the Paris Club. The response was immediate. Peru lost access to international credit, foreign capital stopped, tax revenue collapsed from 15% of GDP in 1985 to 8% by 1989. By 1990, Peru owed $950 million to the IMF. That was half of the fund's total bad debts across all member countries. 2 years after his first address, Garcia went on national television and nationalized 10 private banks, 17 insurance companies, 6 finance companies. No warning, no legislation. The announcement was the law. Overnight, private sector confidence vanished.
Hey, sorry to break in right now, but if you want to take advantage of this, because when this all goes down, so is crypto, and it's going to be an incredible time to buy, but you got to learn how to do it right. You got to learn how to do it safely. And as a new person, you got to be able to know all of the ins and outs, save time, save money, and don't be like your friend that lost a bunch of money in crypto because they were stupid. Links down below for the Bitcoin 101 and XRP course. And at the same time, you get the crypto security course all meshed into one little thing. All right, now let's get back to this video and try making some money.
The central bank lost its independence. Monetary policy was no longer about price stability. It became fiscal survival. The government could not collect enough taxes and could not borrow. The central bank printed the gap. Real GDP per capita fell from $1,203 in 1981 to $729 in 1988. That is a 40% collapse. Poverty hit 55 to 60% before the second currency replacement even happened. The printing led straight to the currency sequence. February 1st, 1985, 1,000 old souls became 1 inky. The government called it administrative simplification. July 1st, 1991. 1 million empties became 1 nuevo sol. Same reason. 2 conversions, each one at admission that the old unit was now useless. Together, they wiped out value at a billion-to-1 ratio. The forced reset landed on August 8th, 1990. Alberto Fujimori had been in office 11 days. His finance minister, Juan Carlos Hurtado Miller, went on television and announced the Emergency Stabilization Package. Gasoline jumped from $21,020 to $675,020 overnight. That is a 3,000% increase in a single night. Every truck, every delivery, every price moved with it. Hurtado Miller ended the broadcast with 5 words: Que Dios nos ayude. May God help us. Annual inflation dropped from 7,650% in 1990 to 139% in 1991. The shock therapy worked, but only after the currency was already gone. Peru was not alone. Bolivia peaked at 23,447% inflation between April 1984 and September 1985. Argentina hit 20,266% between May 1989 and March 1990. Brazil reached 682.1% between December 1989 and March 1990. 4 countries, same region, same decade, same structure. Fiscal collapse first, central bank capture second, printing to fill the gap third, currency redenomination at the end. The warnings were always there. In public data, a year before the worst, the same 3 markers, every time. Rosa Medina in a small clothing shop in Lima's Miraflores district. She did not have an economist advising her. She had a neighbor who had lived through Bolivia in 1985 and told her one thing: get out of the inti before the government tells you to. She opened a dollar-denominated account at a Peruvian bank that offered them in 1986. By the time Hurtado Miller went on television in August of 1990, her savings were already outside the collapsing unit. Her shop survived. Her savings survived. The neighbors who waited for an official signal lost everything before they could act. The households that came through did not predict the exact month. They read the markers and moved before the announcement, not during it. 3 moves kept Peruvian households whole. Here is what they did and what it means for the U.S. now. First, hard assets outside the currency system. Physical gold or silver held value through every redenomination. The government could not convert metals by decree. A Lima apartment bought in 1984 was still a Lima apartment in 1991. The NT savings account was not. For Americans, these are preservation tools, not growth plays. They hold value when the unit of account is under stress. Second, short duration debt, not long bonds. Peruvians who moved savings into dollar accounts or short-term instruments before the forced conversions kept their purchasing power. The US version is 4-week to 13-week treasury bills, not 10-year or 30-year bonds. Duration is exposure. Short duration limits it. Long duration amplifies it. When fiscal and foreign demand data are both moving the wrong way, lacking in a 30-year return in a pressured unit is the wrong side of the trade. Third, income tied to hard currency or exports, not just domestic purchasing power. The survivors earned dollars or produced commodities priced internationally. For Americans, that means any income stream not fully dependent on domestic purchasing power. Remote work for international clients, export services, commodity-linked side income, rental income in markets with international demand. You do not need to call the exact month. You need income that is not trapped in the thing under pressure. The savings passbook in the drawer that said 1 billion soles in 1984 said 1 nuevo sol in 1991. Same account, same drawer, 1 billionth of the value. The households that moved before the broadcast survived. The ones that waited for the official signal did not get one until the damage was already done. 2 of the 3 Peru markers are confirmed in U.S. public data right now. The fiscal deficit is documented. The foreign demand erosion is documented. The Federal Reserve's independence is the one marker still standing between the current trajectory and the sequence that zeroed every savings passbook in Lima. When the passbook in your drawer stops meaning what it says, the time to have acted was before the broadcast. If the third marker trips in your lifetime, will your savings be in the thing that gets replaced or in something that cannot be redenominated? Economic Ninja is out.